Hey, what's up guys? John here. The housing and construction industry right now is going through a major shift.
There's a housing shortage in the country right now as interest rates has fluctuated up and down.
3%, 4% mortgages, we won't see those maybe in our lifetime.
We're stuck in the overall policy situation of simply printing too much money.
Sounds like it's bad news for everybody all involved as mortgage rates push higher again.
Upwards of 20 million Americans could be impacted that are either in the construction industry or the real estate industry, whether it be agents, title reps, escrow officers, home appraisers, inspectors, property managers, the list goes on and on. But this major opportunity is on the back end of all of this disruption that we're walking into right now. And large institutional investors, smart and savvy everyday Americans, they're getting ready for this really, really big shift.
Blackstone and Pradium Partners have backed a relatively new breed of homeowner, the corporation.
How am I supposed to compete with a hedge fund out of Texas on buying a home?
Port of Greater Cincinnati Development Authority bought nearly 200 single-family homes.
Even look at America's biggest home builders, Lennar, D.R. Horton. Everybody that has a plan to make a lot of money is looking at these trends. Well, in this video, I'm going to show you what's going on, what they're preparing for, and what you can do to take advantage of what I believe is going to be the greatest real estate wealth transfer in American history. I think the next 5 years will be the most important in our lifetimes to generate and build wealth and income for ourselves and our families. Please hit the like button. When you do, YouTube will share this content, educate more people about what's going on in the U.S. economy. If you'd like to fix your credit to position yourself for this massive wealth transfer, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative or derogatory items in your credit report, go to GreatCreditFast.com. Click the link in the description just below this video. Schedule a free strategy session, a free consultation with our team before the weekend. Take a look at this. Lennar calls affordability stretched as cracks in the U.S. housing market appear. Inventory in new spec houses spikes to the highest since the GFC, the Great Financial Crisis. Sales grow and builders pile on incentives in trim prices. Well, look at this. Came out yesterday, 256,000 views. Breaking, U.S. new home sales dropped by 128,000 in October to 610,000, the lowest in 2 years. This was significantly below expectations of 725,000. So they were expecting 725 and they got 610. New home sales declined by a whopping 17.3% month over month, marking the largest decline in 13 years. At the same time, the median home price jumped 4.7% year over year to 437,000. So they're saying that sales are, they're dropping, but home prices are increasing. Well, why is that? Well, people right now that have money are looking to invest this depreciating currency, because that's what it is, and that's what it's actually going to be over the next couple of years. It's going to continue to depreciate, where hard real assets are going to be the only thing that, in my opinion, really matters. Meanwhile, the average interest rate on a 30-year fixed hit 7% this month, the high since July. So, cash buyers are stepping in, and they're getting aggressive when it makes sense to. In July, the National Association of Realtors pending U.S. home sales fall to an all-time low in May, according to MarketWatch. Now, here's where things get really interesting. So, are layoffs coming to the U.S. construction industry? U.S. residential units under construction dropped by 17.3% on a 6-month annualized rate in October, the biggest drop in 13 years. Housing units under construction have dropped for 15 straight months, the longest streak since 2008. In previous economic cycles, prolonged declines in this metric were followed by a decline in residential construction employment. The data suggests the housing construction employment may shrink by 10% year over year, 129,000 views. So look at these numbers. You got 10.34 million people in the construction industry. You have 1.3 million people that are real estate sales in the brokerage industry. Then you have another 10,500 home inspectors. You have 70,000 home appraisers. You have 57,000 escrow officers. You have 35% of the U.S. workforce that are now working from home. So you start to look at this big shift. You have the entire real estate industry, people that were tied to transactions that were leasing expensive cars, buying Airbnbs. They were overextending themselves. Well, now that sales activity is drying up, yet their bills are getting more and more expensive. And so when everyday costs are rising, grocery bills, energy costs, everything at home is getting more expensive, and then they have these very expensive liabilities that they're servicing, what's going to happen? Well, something's going to give. And what I think is going to happen is we're going to see a lot of real estate agents leaving the industry, a lot of escrow title reps, home inspectors, and appraisers leaving the industry, trying to find another way to pay their bills. Right? We're walking into this really big shift at the same exact time that 35% of Americans over the last 5 years are now in a position to work from home. Now, sure, some could have worked from home before, but it really wasn't a thing until 2020. So you're seeing this huge shift in the labor market all unfolding. And they say 12 million jobs, which is shocking. McKinsey's saying this 12 million jobs by 2030 are going to be shifting because of AI. The amount of disruption that's going to be unfolding inside of the labor market across nearly every segment is going to be pretty shocking. But those that are positioning their careers with this in mind right now are going to be the beneficiaries of a lot of this wealth that's going to be changing hands. Now, what I find interesting is this statistic around retirees. 79% of retirees own a home, right? Most of these retirees are on fixed incomes. So security, they have a retirement plan. They can live on $2,000, $3,000, $4,000 a month. That was the plan 5 years ago. But then, everything happened, and now the cost of living has greatly increased. And a lot of these retirees are saying, well, what do I do with this home? Do I rent it out? Do I bring in a roommate? Do I sell it?
Shut up and take my money.
A lot of them don't want to sell it. And the reason they don't want to sell it is because they'll take this money and then that's all they'll have. And where are they going to go, right? They're going to go buy another house. They're going to go rent somewhere. They might, blow through that money pretty quickly and then have no other alternative, right? So a lot of people are going to end up listing their homes for rent or losing their homes in foreclosure if they can't keep up with these bills.
In terms of money, we have no money.
Of course, some of them are going to be selling because they're not going to have an alternative. In the third quarter of 2024, 79% of people over 65 in the United States own their home. Then, this fascinating statistic on JP Morgan website, jpmorgan.com, de-dollarization entails a significant reduction in the use of US dollars in world trade and financial transactions. Now, what I'm betting is that inflation is going to likely ramp up in the coming couple years. It's just going to continue to get worse. I don't see a situation where we're going to get inflation, real inflation, back to 2%. I don't see it happening. I think everything is going to continue to get more expensive. And as that happens, the government's just going to have an easier time paying their debt back. Right now, they say that they're adding between 7.9 and 8.5 billion a day to the national debt. But when you go on CNBC, they're saying we're adding $1 trillion every 100 days. So under that math, we're basically adding 3.65 trillion a year. That's a pretty big change from the 2.8 trillion they're saying that we're adding. So I think this is going to continue to ramp up. Inflation is going to get much more challenging, and we're going to see this divide between the have-nots and the have-yots grow over the coming year or two. Now, how this all kind of plays in with this story that just came out 30-45 minutes ago is in California, we're likely going to see more and more and more of these events. They're saying that we could see a 7.0 all around San Francisco area, 7.0, and they're talking about a tsunami. Now, I'm not saying that's going to happen, but I am saying that the last couple of years we've seen a lot of really big things happen in California. We've seen things happen in Maine, all of these other states, right? All of these major events unfolding, costing billions and billions and billions of dollars to property owners and to insurance companies. And I'm betting that we're going to see property insurance continue to grow. And so if we have this affordability crisis and insurance is going to get more expensive, look at Deloitte, for example. They're saying $4,890 is what they think the average insurance policy will be in the next 5 years. Now, the current average property insurance, I just type it in, is $2,500. So they're essentially saying that property insurance will double in the next 5 years. So property insurance is going to double. Energy rates are going to continue to double. The cost to fix your home is going to get more and more expensive. And you're going to start to see a lot of disruption inside the labor industry, and you have a lot of people retiring in the next 5 years. What are you going to likely see? You're going to see a huge decision that millions of Americans are going to be making. Where can I live that's going to be affordable? And so my bet is that we're likely going to see de-dollarization continue. We're going to see our borrowing cost not go back to 2 or 3% on 30-year fixed rate mortgages ever again. I think borrowing costs are going to remain pretty close to where they are now, or possibly even go up. And we're going to see a lot of people chasing affordability. And so certain markets in America, you can buy affordable properties and you can live, on an affordable budget. I think it's going to get more and more common that people are going to be chasing this. And I think we're going to just see these home builders trying to offload this inventory, and they're going to have a hard time doing it. And I think who they're going to offload it to is it's going to be hedge funds, private equity companies, and large institutions that are going to turn these into rental communities. So we're going to see this major consolidation of homes, and I think people that are looking to buy homes, sub, $300,000-$400,000, they're trying to buy these entry-level homes in areas in which insurance will not skyrocket. Smaller properties, ideally, 1,000, 1,200 square feet, where they're cheaper to, heat, they're cheaper for energy bills. Everything is just a little bit more affordable. I think you're going to start to see upward demand and upward pressure on pricing on these properties, and I think we're going to see downward pressure on high-risk areas with some of these homes, inside of Florida, for example, inside of beachfront properties in California. You're going to start seeing more people that might not want to buy those homes. We're going to see a lot of investors saying, hey, now's a good chance to get a bargain. So a lot of really, really interesting things unfolding right now inside of housing that I think could present a massive opportunity for renters that want to become homeowners and investors that want to expand and grow their portfolio. I believe that we're going to start seeing BlackRock and Blackstone and these bigger investment firms looking at real estate differently. And I think they're going to be looking at a big opportunity. And it's not just them, not just these major firms. We're going to see tons of smaller investment shops and tons of smaller institutions that are looking to go out there and invest. But there's just no other way. If you're holding tons of money right now, there's $6 trillion in money market accounts. So much money sitting there. Are you just going to save it if we're walking into an inflationary world, an inflationary environment, or are you going to invest it? If the answer is invest it, where are you going to invest it? You're going to invest it in something that's real, probably precious metals, land, real estate. You're going to want to park it in something you can go touch, something that's going to likely go up in value. And why would these properties go up in value? Because it costs more to build it, right? So if you're buying a house for, call it $300,000, right? If you're buying a house for $300,000 and it costs $400,000 and $450,000, $500,000 to build the house, plus the cost of the land, you're putting a little hedge against inflation. Your neighbor can't go and build the same house for $300,000. They have to spend $400,000, $450,000 to build it. Granted, they have a new house and you have an older house, but the better of a deal that you get, the more you're going to be hedged against inflation. And you're going to be able to rent out these properties to people that are going to have no alternative because they're not going to be able to go out there and buy. It's a sad reality because insurance is going to go up, taxes will likely go up, everything's going to continue to go up, people are going to be forced to rent. So let's have a conversation about this. I think we're walking into a major wealth building opportunity for those that are ambitious, that have big plans. I mean, look at these numbers. It's just pretty shocking. And I don't think this is going to be changing anytime soon. Let's have a conversation below. And if you'd like to fix your credit to position yourself for funding, maybe you're thinking about investing in distressed real estate, you have a really big plan. If you have to pass a credit check or you need to get a loan, make sure your credit score will allow you to get the best loan possible. Because the lower your credit score, the less you're likely going to qualify for on buying that property, the higher interest you're going to pay. And when you're talking about 360 months of payments, 30 years of payments, the difference on a quarter point or a half point because of your credit score could be tens of thousands or possibly hundreds of thousands of dollars over the life of that loan. So if you're thinking about getting a loan or investing in real estate, make sure your credit score is exceptional. And we'd love to help you get there at greatcreditfast.com. That's greatcreditfast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, or any negative or derogatory items or credit report, go to greatcreditfast.com. Click the link in the description just below this video. Schedule a free call for tomorrow, for Friday. Catch you next video.